James, always great to get your expertise on all things China. This has just been a very challenging year for investors who have been bullish on the rising middle class, the idea that China will continue to grow its capital markets. And yet we look at the performance of these stocks because of these regulatory concerns. It's just been a really tough year. Does it change next year?
Yeah, good morning, Seema. It has been challenging, but you think about 2022 globally, and really our theme is normalization, especially for the developed world. And so you think about China and how it needs to catch up in terms of both performance, but also economic growth. And we think there's quite a lot of attractiveness there. You know, in some respects, at the index level, you're looking at the best entry point into Chinese equities in at least 4 years. And so, what's happening is that the index itself is cheap, but also the underlying stocks within China are cheap as well. And I understand that there are a lot of concerns out there around regulatory antitrust, which has been the theme over the last 2 years. There's also the question that's been plaguing investing in China over the last decade, which is whether China will have a hard landing. We had issues with Evergrande and the debt market this past year as well. We think that those are just long-term issues that'll simmer down and basically be in the background throughout next year. But for most investors who are underweight China, especially when you're looking at the onshore A-share market, we think this is a great time to slowly get in. We wouldn't get in 100% right away, but to start getting in at these really low valuations, we think that's probably a good thing to add to most portfolios.
So if valuations look attractive, as I clearly given the stock underperformance, that would make sense, and you're also thinking this regulation story is more of a longer-term risk, why are these stocks down so much? What is Wall Street missing?
Yeah, I think Wall Street is worried about whether China is basically uninvestable because you do have a lot of these one-off event risk type of situations, targeting individuals, companies, and even whole sectors. Earlier this year, we saw issues around regulation with education technology that many investors are familiar with. The challenge, however, is that affects only a small part of the Chinese market. And when you look at the growth of that market overall, the theme going into China pre-pandemic was just the expansion of the A-share market. And we're talking really about some of the largest tech companies in the world, across semiconductors, across electric vehicle, batteries, you name it, financial technology. And so overall, in the long run, investors do need this exposure in their portfolios as that market grows. And this is a great time to start to get in with valuations still low.
Whether it's Alibaba, Bilibili, JD.com as an e-commerce play, is there a certain name here that you think has a better chance of rebounding, doing better, sort of portraying its story to Wall Street in 2022?
Yeah, it's a great point, Seema. So we think this is different from the developed world. The developed world has done very well this year and last year. The index valuations are extremely high. And so you really have to dig underneath the surface in order to find attractiveness at the individual company level. I think it's quite different for China. You look at the index and it's quite cheap in addition to the specific sectors. So what we would be doing is really just looking at the overall sector, overall index positioning, trying to add that over time. And, when you look at areas like technology that have taken quite a hit so far this year, we think that being neutral weight on that relative to the overall index, that's a great place to be.